again, viewers. I'm Shane Ward from ID3. As you know, the purpose of ID3 is to create a better tomorrow by positively influencing change makers, primarily in the commercial environment. During the lockdown, I have released almost daily posts under my personal brand, Shane Ward, with the intention of uplifting the people enduring this unique hardship. You can find these posts on my YouTube channel and my personal Facebook page. ID3 is known for its content on trust in the commercial environment, and we speak it as it is. Trust is a catalyst for success. We also have a burning desire to be relevant, and ignoring COVID-19 would be burying our heads in the sand. We want to continue this trust theme by educating you, which builds and fosters trust. So today, we want to give you, our change makers, economic context in light of the global pandemic. Please note that I said context. We will not be giving financial advice. In no way will we recommend a solution to you, neither will we guide you in terms of strategy. And we will certainly not propose a way forward in terms of your investment strategy. What we will do, however, is educate you in the same way as ID3 has done up until now. If this series provokes questions or thoughts, we will consider doing a live webinar. But for now, we recommend that you direct all questions to your wealth manager or financial advisor. If you know my background, you will understand that economics and investment is close to my heart. And I've run a wealth and investment business on behalf of a large corporate as little as 5 months ago. Today, I will not be alone, which leads me to our guest, Mr. Mark Appleton, or Marky Mark. Mark is a former Chief Investment Officer and today is an independent investment professional. But that's really like calling Usain Bolt an athlete. Mark is so much more than an investment professional and will certainly add his own flavor and color to the series. Mark, so happy to have you in the series. And wow, am I ecstatic to see you with a shirt on and with a freshly combed head of hair. Welcome.
Yeah, Shango, thanks for having me. It's good to be here. Also good to be more formally inspired by your program.
Thank you. Let me start with a rather obscure question that only you and I will understand, but perhaps you can give our viewers a little bit of insight. So if I ask you, how's them onions? What's you give me?
So we live in very strange times, huh? And I guess I'll try and cut this very, very short. But hadn't been out for 2 weeks at least. Decided to do a bit of emergency shopping. Had an order from my wife to go and buy a sack of oranges, amongst a couple of other little things. So with great trepidation, got dressed up, covered my face. Unbeknown to me, when you put a face mask on, you wear glasses, your glasses tend to steam up. Anyway, be that as it may, get to the spa, rush in, see this wonderful sack of oranges, put it over my shoulder, check out, get home, and as it turns out, onions look exactly like oranges.
Well, thanks for that, Bob. Let's get down to some serious business. Can you try and explain to us the gravity of the global economic situation as it stands?
Yeah, look, I'll do my best. And I guess it's probably best to start off with some numbers that have just come out from the IMF. And the IMF's latest forecast from a global growth point of view has swung from in excess of 3.1% positive for 2020 to more than 3% negative. In other words, the size of the global economy will be at least 3% lower by the end of 2020 than it was at the beginning of 2020. And of course, there's some provisos to that as well. You probably find the risks to the downside to that, because in their basic premise, in terms of those numbers, they are suggesting or assuming that we recover from this pandemic in the second half of 2020.
I mean, that is a very rapid turnaround. And, if I look back to 2008 financial crisis and even back to the Great Depression, this is blitz. What has sparked this massive reversal?
It's quite amazing. In fact, it's the fastest reversal in history, the history of humankind, as I understand it. And really, it's with the great financial crisis in 2008, 2009, it was a gradual story. There were problems with the banking system, etc. Banks were part of the problem, and then it started to fall apart. With this particular situation, it's been a huge shock to the system. Can you imagine, for example, waking up and finding a burglar at your door? Automatically, you get a big adrenaline shock, and you run around and you start to panic, and you do a whole bunch of different things. And it's kind of akin to that, because the world really didn't see this coming in any way or form. We were woefully inadequately prepared for it, and it caused shock in the marketplace. It caused the rapid decline was so rapid and so significant that we started having liquidity problems. Certain markets started to freeze up until the Fed and various authorities had to step in. But yes, very, very, very significant reversal. And I'm afraid the uncertainty still is quite prolific out there.
Yeah, that's frightening and interesting at the same time. Can I pull you, Mark, into the South African context and ask you, where does this leave South Africa? Where do we stand in the midst of this crisis?
My heart really goes out, from a South African point of view. One must understand that emerging markets typically, what I call a high beta play on global growth. Now, to the degree that global growth is going negative, it basically means that emerging markets will tend to be even more negative. And I'm excluding China from this, and Asia. But it would appear as though, the IMF is coming out with some numbers for South African growth of around about 6% negative. And frankly, the Reserve Bank concurs with that. They've just come out themselves and said it's minus 6.1%. And then there's some gradual recovery thereafter into 2021, but again, that remains to be seen. So it's the biggest problem from a South African point of view is where in the developed world you have these significant responses from governments in terms of fiscal stimulus. They've unleashed mind-bogglingly large numbers, trillions and trillions of dollars in terms of responding to the crisis, as well as monetary stimulus from the Fed, where they will go in and guarantee loans and provide liquidity where they can, buy bonds, keep interest rates very low, etc., etc. Unfortunately, we don't have the same sort of firepower, and to that end, if this pandemic gets a lot worse, then we have potential issues which need to be addressed.
So what does it mean if we take it down to basic level, my neighbor, the guy next door? What are the implications for that dude?
Yeah, see, it's economies are so interlinked nowadays. So when you shut down the economy to try and rectify or to try and contain this pandemic, you basically are shutting down the livelihood and cash flow lifeblood of companies, and those companies can't really afford to keep their staff on, and that kind of results in a rolling kind of unemployment problem. In fact, I think I'm seeing some numbers here which suggest that by the end of 2020, 500,000 people would have lost their jobs in the South African context. Now you can understand the blow to purchasing power and consumption spending as a result of being unemployed is significant, and it knocks on. You've been selling to people with some purchasing power. All of a sudden, you can't sell to them. It has an impact on you. So it's a very, very serious story. In fact, depending on who your neighbor actually is, I know where you live, Shane. Depending on who your neighbor is. I've been talking to some small business owners, and they've been saying, look, they can maybe last until for another week or two to pay their employees, but beyond that, they're going to have to get some serious support from the authorities, and I'm not entirely sure how clear that support is at this particular point in time.
Okay. Yeah, it's bleak, but I think we know that, and I think worse still, we're not sure how long it's going to take to get better. So let me turn to an analogy. Hopefully, it's not too cheesy. I think everyone's using these analogies of a sick patient, but when you find yourself critically ill, you go see a physician, and that physician plots a path forward, hopefully with the end result being health restoration. It may require a surgery initially, but normally quite a long regime of medicinal treatment. My question is, could the cure in this case be more deadly than the disease?
That's quite an insightful question, and it's a question that people have been grappling with all over the world. It's a question of how deeply do you have to put the economy into a comatose state to treat the patient. In fact, I've seen some really interesting quotes. Paul Krugman, who's a prominent American economist, said that this is the economic equivalent of a medically induced coma.
I found that it's almost, that is such an apt statement, because it's exactly what we've done. We have forcibly switched off, I mean, of course, with good intent, but we have switched off large sectors of this economy. Like we have put the economy exactly as beautifully put into an induced coma.
Absolutely. Now the key is when you bring the patient out of this coma, and that's I think where a lot of investment markets and a lot of investors are really focused at the moment, to say, well, how do we come out of this coma? What is the plan? What is the government's intention? Is it just a continued generalized lockdown, or is it a question of maybe understanding the extent of the disease a lot more? I've seen some numbers here that every day that this lockdown continues, it's costing the economy about 13 billion rand. No? Yet I've seen some numbers that to get a full-scale testing, full-on drive in terms of testing, it'll cost about 5 billion rand a year. So it seems quite obvious to in terms of the partial solution is to get the testing so that people have data. And once you have data, you can start to unlock parts of the economy. If somebody is clean, you let them back into the workplace, and you start concentrating in areas like mining, perhaps, or agriculture, and then you roll it through in terms of manufacture. But we really need to get, or to reduce the sense of uncertainty. We need to start seeing those kind of numbers, and that, I think, will give the market something to be a lot calmer about. Just one thing, while we're talking about medical analogies, there's another analogy doing the rounds, and that is coming from Lawrence Summers, who was a former U.S. Treasury Secretary. And he kind of said, look, this is like chemotherapy, because chemo, you've got to poison the patient to really ultimately poison the virus. And unfortunately, the longer you adapt a chemotherapeutic response or treatment, the sicker the patient tends to get. So one needs to bear that in mind. So it's going to be a very, very delicate kind of balancing act here.
Okay, thank you. Psychology of investment, or behavioral economics, or behavioral finance, says there's two responses: the way an investor should respond, and then the way an investor does actually respond. And the void between the two is rational thought, or really more aptly, the lack of rational thought. So, when we go deeper into behavioral economics, loss aversion has been very clearly understood that an investor suffers so much more pain when losing money than compared to the joy he experiences in the equivalent gain of money. And then adding more to the psychological response, when you flick on to your investment profile now and you pull up, there could be a wide array, and you see really your hopes and your dreams being diminished so drastically, such significant losses in such a short period of time. What happens is, it's called an amygdala hijack. Your amygdala, which controls the emotional response of the brain, hijacks your cortex. Now, your cortex is rational thinking. It is logical. It is problem solving. So every time you see these massive losses, your brain almost gets tricked into believing it needs to fight or flight, which is a wonderful response if a lion is chasing you. But the truth is, this may not be the greatest response in the face of the crisis we are currently looking at. So this is a tough question to ask you, but to what extent would you estimate, or how you can answer it however you feel comfortable, Mark, but there's a psychological knee-jerk reaction to some of the valuations we are seeing. Can you perhaps chat to us about evaluations and whether you would agree that perhaps there's some psychology behind this thing?
Yeah, in fact, the market has been incredibly volatile. So it pretty much speaks to what you're saying in terms of this desperate fear of losing capital. Well-earned capital throughout your life. To what degree is it going to diminish your ability to service your retirement years, etc.? I mean, you can understand where the fear comes from. I'm not going to tell you. I'm not going to kind of answer the valuation question. What I am going to do is to try and provide some perspective in terms of how I think your viewers should look at this, and that is to say, let's try and step back from the emotion if we can. That is very difficult to do, and to say, how should you be looking at the investment kind of assessment? And to me, you've got to have an idea of how you expect, or your financial advisor or wealth manager expects the world to develop, from a macro point of view, and then you've got to work it backwards in terms of what does it mean for earnings and cash flows and dividends and a whole bunch of different things. And once you put it down on paper, you can work it back. So, for example, in the early stages of this crisis, there was such panic. It seemed certain shares fell so far. It seemed to imply that this pandemic was going to be with us for 10, 20 years. Which I think is probably would be an outlier in terms of an assumption set. But that panic did bring those situations to bear. And then you've got to say, well, okay, so then you come back to a fundamental assessment of the value. What the problem was in this particular instance, because it was so shocking and so fast and such panic-induced kind of behavior came through, you found a lot of people who would normally buy a stock, they disappeared. So there was a liquidity problem. So a panic seller just said, get me out of the market, come what may. And of course, it wasn't necessarily the right thing to do, because just because we call it price discovery in the investment business. What is price discovery? Price discovery is where it's a liquid market, and you tend to find the prevailing price is roughly what the share should be priced at, just more or less. So obviously, there are different situations. But in this particular instance, there was no liquidity. The liquidity dried up, and the panic selling just hit those very, very low bids. And that became a problem, because when the market starts to calm down to some degree, there is a bit of a bounce back, and we've seen that to some degree. So it's really a question of perspective as opposed to an approach as opposed to an assessment.
Thank you. All right. So I think we all become relatively comfortable with the fact that this is going to be a rough ride, and the ride may continue for quite some time. But in broadly speaking, what are the long-term implications we as South Africans should be thinking about?
Okay, well, but let me talk about maybe some of the longer term global implications first and foremost, if I can do that very, very briefly. So remember, the world has been going through a prolonged period of very low inflation. And that was one of the reasons for that was that there'd been significant globalization, and unit cost of labor had been coming down with the entry of the Chinese, and they'd been pretty much exporting deflation or disinflation into the world. Now, I think things might start to change. I was listening to an interview with Marco Rubio, who was one of the Republican presidential contenders some time back, and he was kind of suggesting that there might be more emphasis on the reliability of the supply chain as opposed to the efficiency of the supply chain. In other words, instead of getting your face masks from China, you would have a definitive sourcing from America itself, etc. Now, that might move the cost structures up quite significantly.
And Marcus, we've realized that we are vulnerable. So countries realize one component can stop an entire manufacturing process, and that component came from Canada or China. And now we want to almost reduce that vulnerability and start doing a few things ourselves.
Absolutely, absolutely right. So, but it has inflationary implications. Now, you've got a higher cost structure, and basically you've still got the world on steroids in terms of all the stimulus floating around. And they're probably going to be a bit reluctant to withdraw the stimulus too quickly, because their debt levels have gone up dramatically in terms of trying to make economies survive. And so you're probably going to find a higher cost structure and a lower the demand story starts to normalize, and there's quite a bit of stimulus still around, which is quite inflationary. Now, when we take it to the South African context, now South Africa unfortunately finds itself in a very tough spot. We've got, I think, debt levels. We spoke about the unemployment going up dramatically. The debt levels have gone up, or are estimated to go up, from 6% of GDP to about 12% by the end of the year. That's very significant. And then you've got to ask yourself the question: well, how does South Africa get out of this particular hole in terms of servicing that debt? Now, the debt levels have gone up because of the risk-off version by the rest of the world. Our interest rates have gone up. The rest of the world are seeing us as quite a risky proposition, and unfortunately, the South African government has to borrow into that higher yield structure as a result of the risk aversion from the rest of the planet, which leaves us in a very, very precarious position, which the government really has to handle. So I think there are certain longer term implications as far as that's concerned as well. I don't know if you would like me to continue with that.
Yeah, if you can.
Okay, so you got to ask. Okay, so how does South Africa get out of this debt hole? Well, the first prize is using this crisis as a springboard to reform the economy. They've been talking about reform for a very long period of time. In other words, you get to a situation where you remove barriers to business, etc., when things start to normalize, and then you grow the economy out of the problem. And that's clearly the first prize. The second prize, by far, is to inflate your. So the greater your inflation rate is, the less your debt burden, your existing debt burden actually is. Now, I'm kind of, I think the signs that certain people should be watching for. I'm not saying this is going to happen, but it would appear that to help fund these increasing deficits, you might find the PIC gets brought into the equation. You might find prescribed asset requirements coming through, all designed to reduce the cost of borrowing, and also the Reserve Bank itself might, in fact, institute some kind of quantitative easing program over and above the liquidity that they've already been providing. Now, that is highly inflationary at the end of the day, and it's not very good from a currency perspective. So I would suggest to you that the probability or the risks in the longer term have gone up, that maybe this could be quite inflationary, and also when that happens, you've got some pressure on the currency.
So then you've kind of answered it, but I'm searching so hard to find some positive out of this and a little bit of silver lining. So you've addressed these things, but is it at all possible for us, as quite a resilient country, to eke some positives out of this real negative crisis we find ourselves in?
Yeah, look, I think if the world starts to control the pandemic, then by definition the risk off starts to dissipate. The rand will start to recover to some degree. We institute a proper reform program. These are potential very significant positives. The other thing which one also should be aware of is we have a very young population, and that should be quite resistant to this virus. So it's just be aware that there are certain silver linings out there. But I think in terms of the uncertainty levels and how you price it into investment markets, it's quite tough. Do you take on more risk at this particular point in time because yields have gone up and are so juicy? I would suggest to you that a prudent investment stance would be to adopt a cautious stance at this particular point in time.
Mark, is there anything else you want to add? Otherwise, we can do an electronic fist pump and end it here.
No, I think that's fine. Look, it's tough times. So I hope everybody keeps safe, and I sincerely hope that your viewers keep a calm disposition if they can. I'm trying to.
Thanks so much, Mark. Lovely to have you on the program, and hopefully we see you soon. Ciao.
Cheers. Ciao.